We're very selective in terms of how we grow. We haven't grown nearly as large as we could have, both in personnel or in terms of capital raised. Mainly because we think the venture business is a lot more fun if you can do it with a small group of close friends who enjoy being around each other and who can make good decisions together.
Hi, Paul. Thank you so much for coming on to the show.
It's a pleasure to be here, Grace. Thanks for having me.
Can you tell us a little bit more about how did you grow up and how did you get into venture capital?
Sure. My path is a little unusual. I grew up with my father was a naval officer and he was a submarine commander. So we grew up around naval bases all around the U.S. I went to the Air Force Academy and I flew airplanes on active duty for several years before going to business school. And then out of business school, I spent several years working on Wall Street for investment banking. And for about a brief microsecond in 1999, the window to venture capital opened up and I managed to slip through it. And we started Meritech Capital back in 99, and I've been doing that ever since.
You were in investment banking, sort of raising capital for the funds, and tell us a little bit more about how did you kind of make the transition? What did you see in venture capital that's drawing you into this industry?
So when I was in investment banking, I was actually working at a company called Montgomery Securities, which was based in San Francisco. And Montgomery had this concept that if they did private placements for some of the more promising tech companies, they could qualify as their banker to go public. That's where the real money was made. That was the real impetus for having a private placement group. And private placements were small. I mean, these last rounds being raised for tech companies, they would raise 10, maybe $15 million on the upside for a company who then would go public after going through that. But as part of that, doing that for several years, I got quite familiar with the characteristics, the most promising companies, not only that were coming out of the venture space, but the ones who were more interesting to the banks who looked at them as which ones would be great public companies. And there is a difference. It's a very fine filter. And so I actually was able to refine my own perspective and judgment around which were the most interesting private companies, what characteristics do they have, what do the management look like? And that was essentially the training I had for going into the venture capital industry. Now, I did get invited to join venture capital really by a couple of iconic guys from the earlier era. And they were specifically Bandel Carano of Oak Investment Partners and Jim Breyer at Excel, who had this concept that they should have a fund that would be independent of their early stage focused venture firms, but would work with their most promising later stage companies to fund those that were most deserving and had the most upside. And that's how we formed Meritech, really more as a joint venture between 4 early stage companies and a couple of us who came in to run it.
What kind of characteristic would a company succeed later on? And in terms of building relationships, how did you manage to meet all these expert in the fund? And then what kind of actions do you take to actually cultivate the relationship into a more efficient relationship at work?
I will tell you, it's very different today than it was back then 20 years ago. When we didn't have nearly the information sources, the internet stories, the focus on promising tech companies. And by the way, there were a lot fewer of them too. It was a really small group to choose from. So it was easier to look around at a few prominent early stage venture portfolios and try and pick the best few out of each and then get to know them and then build a relationship, which was much easier at the time because there weren't a lot of late stage. In fact, there weren't any late stage funds who were talking to them, and they were quite interested to speak to anyone who would potentially write a check in the early 2000s because there was no other money. I mean, it was a very dry, quiet time in the venture space. Today, of course, it does look a lot different. Today, there are many more sources of capital for promising companies. There are many more companies who are doing so many more things than they were doing in years past. Today, companies that would be an average late stage company would have gone public at their size years ago. And of course, today they go much later, much more mature, much larger companies going out. Anyway, sources of capital and interesting companies, there's lots of both. So it's a very different dance to get to know companies. It's always best to have an introduction from a board member or someone who's close to the management team. It's helpful to have a brand name, venture fund, that they have seen fund other companies they respect and admire. And it's helpful to come in with the Meritech approach, which I love to say is very low ego, very help-oriented for companies. And we're actually just grateful to have the chance to talk to and work with many of these promising companies.
What is some action that you took early on in your career to kind of build these kind of relationships?
You know, the best way to build a relationship is actually to help somebody, to do something that's tough or to help someone. And so one cannot do that in one meeting or two meetings, which are more superficial and not intimate. But after you've been in the industry for a long time, you get to know a lot of people from sitting on boards with them, from looking at different opportunities with them. And that is actually tremendously helpful to me very late in my career here with lots of relationships throughout the industry. I can call and get insights into companies. I can get access to entrepreneurs and so forth because I've worked with many of these folks in difficult situations, got through processes that were harder, or assisted them in some fashion when they needed to know something. And that's what I draw on today. You know, for young people who are starting out, my advice would be, you know, you're going to have to invest a lot of time and energy doing things that don't pay back right now. And that may never pay back. But if you want to have enduring relationships, be a great human. And you know the old saying that our mothers used to tell us, if you want a friend, you have to be a friend. You know, that applies to this business too.
In terms of like picking the right company, can you kind of walk us through about like how did you meet a company like Facebook, Salesforce, or any company that you've invested in? Like what do you see in them, and like did you invest in them right away, or like how did that go? So like for you to invest in a particular company.
Well, they're both really interesting stories in the sense that it's not like you would have imagined. So Facebook in many ways was a bit accidental. At the time, and this was 2005, MySpace was the dominant social media platform. It had many more users. It was widely available. It had more revenue. It was followed avidly by printed media and so forth. So its profile was much higher. It was a much more interesting company. We tried very hard to invest in MySpace, but while we were negotiating with the team, the company was sold. And it was sold because there was a majority owner of the stock in the company that was not the management team. They were actually outsiders, and they, Intermix, I think is the name, down in LA. They actually struck a deal with Fox Media to sell that company for $500 million, which was a spectacular number. That 500 is noteworthy because we turned around and thought, well, this is a great space. It's new, but it certainly is going to have longer term legs. What will be the most interesting next company in that space? And 2 blocks away from us in Palo Alto was this young company called Facebook. And Facebook was literally on 30 college campuses, and that was it at the time. But it was an interesting company. It was starting to get some press. I remember reading an article in the local newspaper about some young woman who had gone to Berkeley and was having trouble going to class because she was spending so much time on this new thing called Facebook. And I thought, that's fantastic. That's great. That sounds like an interesting company. So we actually reached into our friends at Excel and said, we know you invested in these guys a year ago. Could we meet them? So I went down and met them and liked what we saw. It seemed to have a great deal of promise, albeit they only had $10 million in revenue at the time. And we said, well, what's the price? And they said, well, $500 million. You know, $500 million for a company with $10 million in revenue is actually crazy today. And it was much more so back then. But we swallowed hard and we made the investment. And of course, it has turned out to be the best investment that Meritech has ever made.
Like, what made you decided to go all in since like their price was super high? Of course, you saw the MySpace success, but like, what made you decide this is a company I'm gonna go for?
Yeah, I get asked this frequently about all the investments we make, and it's hard to articulate it, but I will give my best. There's a combination of things that we look at. We're looking at the management team, we're looking at the product, we're looking at the growth rate, we're looking at the monetization ability of that product, we're looking at the market size, we're looking at the other ability to attract talent to work on their platform and so forth. And all of these things combined together, some are good, some are not so good, and trying to make a great judgment. What we saw on Facebook, though, at the time was social media was really starting to explode. And it was exploding in the sense that because iPhones or I should say smartphones had gotten better, computers and desktop, it was all desktop really at the time, but because desktop systems had gotten better to the point where there was great internet connectivity and so forth, so the infrastructure was supporting this. And we could see how quickly the younger generation was adopting this. This really was important and valuable to them. And we knew if they could attract the best students at the best campuses, this was something that had tremendous legs. And so we really thought in the next several years, it could be something tremendously large. That was really the biggest driver. And of course, Zuckerberg with his team, he really did have a band of all-stars. I mean, it was an amazingly talented young group, but they were absolutely determined to change the world in a way that they did eventually.
At one point, have you encountered two companies that are doing the same things and like you went with one particular company instead of the other? Why did you pick that particular company and like not the other one?
Well, it's harder today. And it's harder in the sense that there's so much money in the venture world that any company that shows great traction immediately attracts 5 competitors that can instantly market very well.
Yeah, that's so true.
They just fight it out for leadership in a space. In fact, it's very unusual to find a company that's alone in a space now. And that's usually a sign of a less interesting space. So as much as we don't like it, having competitors is a good marker indicator of a good market. What are we looking for in those companies? In those cases, the management team and the talent of the team matters a great deal. That's where middle America just doesn't compete well. So someone with the same concept and determination and drive in Chicago is just not going to have access to the same talent pool and advice and support that someone out here in Silicon Valley can get. And so, we look at that. We look at where their traction is. We look at how fast they're growing. We look at how thoughtful they are in a business model. We look at ultimately how big the market can be. Some companies are reasonable investments. Meritech is not seeking to be in reasonable investments. We want to be in great breakout, outrageously large, successful companies. And so we're looking for the management determination to build that kind of company as well. There's lots of very determined management. There are relatively few that are really focused on doing something huge.
As a venture capitalist, how do you define like what companies like how big the market is for a particular company?
That is a very tough thing to do at times. I'll give you an example though. We invested in a company called TeleAtlas. Must have been back in 2002, 2003. So what TeleAtlas was, it was literally in the same business that another company called Navtech here in the US was in. And they were digitizing the maps of different parts of the world. TeleAtlas was primarily in Europe, and Navtech was primarily here in the US. And the only market they really had for those maps were car manufacturers who needed a DVD, maybe a CD to start with, of digital maps to put in the very earliest sort of in-car mapping systems that were available back then. Or they would sell to Garmin, who would have a attachment that you could put on your dashboard. And they would also sell some maps to these online mapping things. MapQuest was a company that did it. Google got into it later, but I think they were starting out back then. And they had to buy digital maps from someone who had digitized it. So it was a nice little industry. But it was clear to us early on that the scarcity and the difficulty of creating these maps meant that these were unique resources whose maps could be used in a lot of future devices. And the first smartphones were coming out, and sort of we dreamed ahead as to where they might go. So we invested in TeleAtlas, and it turned out to be a really good one. We were very pleased. Went public, ultimately got acquired by another company and so forth successfully. But that was one where we sort of dreamed ahead and could see what that unique resource could end up being.
As a later stage investor, how do you quickly study an industry, become the expert in an industry, and then picking the best one from the industry?
Well, it's a lot easier for later stage investors. Because
the numbers.
We have numbers to look at. We have growth rates to look at. We have customers to talk to. Now, that being said, one still has to choose and choose carefully, because there's an awful lot of later stage companies that have good numbers because they're small, but that doesn't mean they will translate into successful large companies. And very few of them actually do. So we do have to be particularly careful. But for us, it does involve a lot of work. We really do need to call several things. We try and talk to competitive companies or those who know competitive companies. We try to talk to customers to figure out why they're buying a product, how they expect to use it, how valuable is it. And by the way, customers see it very differently, so you need to speak to several of them. And then ultimately, we have to try and find who has an overview on the space. And we're fortunate to have a lot of portfolio alumni who are sprinkled throughout the tech world and elsewhere that we can reach out to and get their perspectives as well, to figure out what is the size of this market. By the way, big market in 10 years is not nearly as interesting as big market in 3 years.
Can you walk us through about like maybe a particular case that you've studied that like in the past, like how did you kind of master it? Who did you talk to? And how did you like sort of like come up with the conclusion that you're going to invest in them?
Sure. Braze may be a good one. So Braze is a company based in New York City. They do a lot of in-app messaging. I am sure they have messaged you when you were particularly ordering food more recently online. Braze is probably the in-app communication that might tell you where your driver is, that your order was received, what time it's going to get there, and so forth. They do the same in the music industry. When you're listening to online music, they might send you special offers from another retailer and so forth. Anyway, that turns out to be a very sophisticated and difficult thing to do, which is message clearly, accurately, and be used for multiple ways of communicating between companies and their customers. We had a sense that, particularly as online retail was growing years ago, this would be an interesting space, but it was very crowded. I mean, there was Urban Airship, Iterable, and Braze, which was known as Appboy at the time, and several others that were competing to be in that space and be the provider. And there wasn't a lot of differentiation between them. And I'm talking 5 or 6 years ago. And if there was any, it may have been that Urban Airship was kind of in the lead because they were sort of first to the space. But none of them were interesting enough to us. So we decided to watch the space and to watch what happened. Well, as it turned out, some 3 or 4 years ago, we sensed that the Braze team was starting to leap ahead. There are a bunch of young, very thoughtful, engineering-oriented types who had constantly or obsessively improve their products. So it was faster, it was easier to use, and the customers responding by starting to buy it. And as we got to talking to them, as it appeared to us they were breaking out, we went and spoke to a lot of different customers of all of those different products. And it was clear the Braze customers were happier, more thoughtful, more appreciative, and they thought the team was more responsive to their needs and so forth. And so it became clear to us that that was the one to back. And so we invested in them 4 years ago. We've reinvested a couple of times since then. And it is clear that Braze is just running away in that continually growing industry there now.
So how do you checking in with these kind of companies? Do you sort of like set up news alert, or do you like just like have a spreadsheet on like, oh, this is like this company is racing the next round or something like that?
We use a couple of things. One is we have a massive database that has several thousand companies in it.
Mhm.
We try to rank and stack those as more interesting to less interesting.
Mhm.
We're constantly updating that. We also have some proprietary data collection systems and algorithms that we run against that group to
Mhm.
identify the most promising based on a couple of metrics that we find most relevant. And then so we focus on those that pop out at the top of that process. We're a small team. We have literally 6 investing partners here at
Mhm.
Meritech. So we can't spend a lot of time on things that aren't more near term, more interesting. And
Mhm.
so we've got to constantly triage which ones do we spend time on, which industries do we deep dive on, and then move along as we determine positive or negative. But that's what we've done literally in different forms for the last 20 years. So it seems to be working.
Do you think in terms of like venture capital will switch more towards like the data driven focus, and what kind of data do you sort of like putting into the system? Is that going to be like how much customer are spending and like all that kind of like consumer data, or like is that more sophisticated in a way?
So I can't comment on correlation specifically, but there
Yeah,
are
yeah,
others
I'm
that are
not
like that.
yeah.
One thing I suspect you will find when you dig deep in their algorithm is that one of the factors they look at and weigh most heavily is who are the early stage investors.
Yeah.
So it's essentially going to a already very select group of companies and then looking at some financial metrics around those to find the most promising. So, is that process going to replace venture capital? I don't think so. I mean, there still needs to be that initial filter for what's most interesting. The brand name early stage VCs that we all know and recognize, Sequoia, Excel,
Mhm.
and the likes, they're going to continue to have access to the best companies and then be very thoughtful and selective in terms of which ones to back.
So basically, selecting the right people to back the right people is
Right.
kind of the strategy there. Curious, how do you position Meritech as like as a fund to kind of like getting the best deals as a fund?
Well, there's several things. One is, personal contact and
Mhm.
speaking to people is a really big element of that. I think we're helped a lot by a reputation for
Mhm. Of
being in
course.
many of the great companies over the last
Mhm.
20 years. So we are, well, we're not a household name, and we certainly don't have the prominence of a big early stage VC. Within our world, within the late stage company world, entrepreneurs and other investors, we are reasonably well known. And I would
Mhm.
like to think we have a good reputation there for
Mhm.
not only picking the right companies, but equally importantly, being very supportive and helpful in
Mhm.
a very low ego way to entrepreneurs who are looking for help, looking for
Mhm.
something more than just a check from a brand name, but looking for assistance in thinking through some of the issues that are unique to later stage companies
Mhm.
and building a team that can take them to the next level.
Like, what are some action that you actively taking to creating these brand or this sort of like how do you select the partners? How do you select who you investing to like sort of like build this really well-known brand within
Yeah.
the later stage investing?
Well, for one thing, we have been really careful. Well, I will tell you, we never lost a partner over 20 years, which I
Mhm.
think is it's an unusual track record of
Mhm.
stability within a team. We did have one retire last year, actually 2 years ago now. Mike Gordon left us. He retired, but he was a wonderful contributor with us for 18 years. We're very selective in terms of how we grow. We haven't grown nearly as large as we could have, both in
Mhm.
personnel or in terms of capital raised.
Mhm.
Mainly because we think the venture business is a lot more fun if you can do it with a small group of close friends who enjoy
Mhm.
being around each other and who can make good decisions together. We've been particularly careful to find really thoughtful, capable, ambitious young people
Mm-hmm.
who also have wonderful EQ skills. They get along with others. They're going to be helpful in a very low ego way to entrepreneurs that we back. And they won't fit the stereotype of VCs of being sort of arrogant and hard and difficult to work with.
When you pick the partners to join Meritech, or when you first started, like what kind of personalities or what kind of characteristic does a person bring onto the table to form a really good firm?
Well, so the early group was myself and Mike Gordon and Rob Ward. Mike Gordon was a research analyst at Montgomery Securities, where I was, covering the telecom industry. And Mike was widely respected throughout the investor community for writing in-depth research and understanding many of the dynamics around the telecom and essentially the infrastructure to the internet, which was the biggest investment theme at the time. And he was a decent guy who people liked and felt comfortable communicating with. So he fit the bill. Rob Ward was my colleague at the private placement group at Montgomery, and he and I had worked closely together. Rob's the same way then as he is today, which is a very, very thoughtful, smart. He may be the best late-stage investor in the U.S. right now, by the way. And he does it in a very low-ego, helpful way. People love him, and they love to get his advice. I love to be around him. Anyway, so the three of us were really the first three, and we have tried to replicate that model and that style as we have looked at and brought on our later team members.
What kind of track record do you have back then to kind of go on to kind of raise the amount of capital?
First-time funds are always the toughest because the biggest pool of money, of course, are institutional capital, the foundations, the endowments, and so forth, who don't want to invest in first-time funds. They really want to invest in individuals. Now, they do invest in individuals they have known who spin out to create new funds, and they have seen their work, and so they can get comfortable with them. But they don't even like to do that a lot. When we got started, we had unfair help from Excel Partners, Oak Investment Partners, and Redpoint, who actually took us around to their own limited partners at the time and said, "This is our late-stage partner. Please join us and invest in them." I mean, a group of guys from Montgomery Securities would never have been able to do that. And so we got started with the help of those sponsoring funds. And then we raised our next fund the following year, year 2000, also with their help. And we didn't really go independent in the way we are today until later in 2003. And of course, since that time, we've had our own track record to show and rely on, and we have.
So what are probably a couple like characteristics that you feel like you have compared to your competitors back then to have built this kind of reputation within the industry?
Certainly, I knew a lot of venture capital groups who we had done private placements for, so that helped. But I didn't know any LPs. The LP world was foreign to me, and so the help from Excel and the likes were tremendously valuable in both meeting the right folks, getting the right sponsorship, and then having a concept which was new at the time. Late stage investing just literally wasn't a space because companies went straight to IPO after early stage fundings. So that was a concept that actually resonated with some limited partners and did not at all with others. So we were the redheaded stepchild of the venture industry for many years. Ironically, today, it is the biggest part, the largest amount of capital, the most dynamic part of the venture spectrum, the venture continuum, I should say, is really late stage. So it's fascinating to see how that has changed over 20 years. But back then, wasn't a popular place to be. We really did need the sponsorship and support of those early stage venture icons in order to be able to raise a fund.
Like, what would be the conversation goes into convincing someone like that to kind of like work with you? What kind of ability do you have to build on your own to make them see that you're a valuable asset to the team?
Well, back then, I mean, it was kind of a double sell because it was a space that the LPs weren't familiar with, and they had to hear a story about what the opportunity set was. We had to have examples of companies we could have invested in recent years had we been up and running. of what was in the sponsor fund portfolios that we potentially could invest going forward, and then explaining what kind of return opportunity versus risk that presented. So that was a complicated story. Now, it was in 1999. There was a lot of excitement over the venture industry, which was every fund was succeeding back then. A lot of money wanted into the space, and that was really helpful to us. That's it. It's different today. There certainly is a lot of money that wants to come into venture, but they're trying to get to the brand names, the familiar names, the groups they know, they've heard of. And so for the lesser known groups and the new groups, it is still a large challenge. It helps a lot to have an investment track record of some sort, have at least a few members of a team who have invested and claim attribution to certain deals, who have unique expertise, whether working at or being around certain iconic companies that limited partners can recognize, and then being able to convey sort of the less metricable stats, the determination, the insight, the ability to communicate and win relationships. That's the third part that one must do.
How did you sort of like meet for example, you mentioned Jim Breyer, who invests in Facebook. Like, how do you meet them in the first place? Like, what kind of personal relationship have to go on to build to kind of like get the initiation for the Facebook meeting or yeah.
Yeah. To start with, of course, as a banker, when one would raise money, you went in to meet the board of directors, and that happened to be the VCs who were invested in it. So, and then, if you were successful in raising that money, that helped your reputation and the like. So that's really how I got started in terms of being able to be the person at Meritech and what was the concept there. That took place over a number of years in a number of different transactions that I had participated in. And then, by the way, turning down the ones where we don't think we could raise money and doing it in a polite, professional way is equally important. That also is really important now. I mean, we look at a lot of companies, many of whom just aren't the right fit for us. They don't have the right ambition. They're maybe a little early. They may, various things. And so we've got to actually give them some feedback and do it in as positive a way as we can. So I always have sought to do that. We all at Meritech seek to do it in the right way so that we have a chance in a couple of years, if that company matures, we have a chance to go out and invest or help them in some way, that we will do it. So that's my personal style. For other people, it's a different kind of style. Some people are a lot smarter than me, and they just, they understand an industry at a level and a deep insight that I will never have. And they yet can communicate to certain entrepreneurs who really want to understand the dynamics in their space, what their competition is doing, what are the movements, what are the customers thinking at some way. And that can be really helpful and interesting to an entrepreneur. And he would want that person as an investor. Anyway, there's lots of different styles. I will say there is a VC versus PE style, which is always interesting. The private equity groups, mega funds, much more money, investing in much more mature companies, they take a very, very hard-nosed perspective, attitude towards their companies. They drive to grow by a few extra percentage points or get a few extra margin points. And for them, it is really more hard-knuckled. We in the venture space, we've got to be positive. We've got to be encouraging. I mean, as much as we have to make harder decisions where to write our checks, being a difficult person in our industry is not helpful, and that does not have to do with information.
What kind of skills did you build early on that you feel like it was very useful later on in life?
As an Air Force pilot, I flew fighter planes, and
the coolest plane in the planes.
Yeah, well, those have been surpassed now, actually. So I flew the F-16 when it was brand new. Today it's kind of old, and the F-35 is coming on. But even before I flew the F-16, I flew the F-4. F-4 was what we would call a third-generation fighter plane. The F-16 is fourth generation. The current F-35 is fifth generation. Anyway, the difference between Generation 3, the F-4, and the 16 was huge. And the difference primarily was technology. Not only was there much better technology in the F-16 engines, but also in the electronic systems on board, the radar system, the navigational systems, and so forth. In fact, from the F4, which took 2 people to fly it, the F-16 only had a single seat because technology allowed that. I've had a fascination with technology ever since that time. And so I came into this business, into the banking business, and then to this business with this focus on technology and a curiosity to understand why certain tech is better, more useful, more helpful. And I think that natural curiosity is sort of something you will see in every great tech investor, because it's above being a job or being something they do 8 hours a day. Curiosity around tech is a 24-hour passion. And unless you have that interest, you just don't develop the insights and the awareness and the sensitivities that one needs to be a thoughtful investor.
So last piece is, who made the most influence in your life, either your career or personal life? And what book do you recommend people to read? Like, what book makes the hugest impact on you? And the third one is like, who would you invite to your dinner party?
So the biggest impact would probably be 2 people that I can think of. There was a gentleman named Colonel Bruce Freeman. Bruce Freeman was my squadron commander when I was flying F-4s in Spain. And he took an interest in me, and he helped me, to learn a lot about the Air Force and fighter planes at the time. And I really looked up to him. He was a real professional, thoughtful, organized person who I idolized in many ways. And unfortunately, he's no longer with us. But I've had the chance to tell this to his kids as well. The other one would be Bandel Carano at Oak Investment Partners. Bandel is clearly one of the smartest people to ever be an early stage investor in the U.S. and invested in many iconic companies throughout the 80s and 90s. He was one of those kids who went to Stanford when I think he was 15 or 16 years old, graduated very young, and has just had a brilliant engineering mind all of his life, very curious and very insightful. And Bandel's the one who, helped us get started, but even more valuably helped us understand what to look for early on and how to make great judgments. Those 2, Colonel Bruce Freeman and Bandel Carano. As far as my dinner, I think I would invite Rob Ward and Mike Gordon, my 2 early partners from Meritech. I would invite a couple of very colorful characters that I've met along the way, and those 2 would be Jerry Kennelly, the former CEO of Riverbed, and maybe Chamath Palihapitiya, who everyone knows as the most interesting, fascinating person to ask for opinions on technology. Chamath was at Facebook, and he was at an investment firm before that. Now he runs his own firm. And I'd also invite my old crew member from F4s, a guy named Steve Haldeman, who went on to become the greatest F-15 pilot in the Air Force, and he's a wonderful guy as well. So it doesn't really have to do with venture investing, but I would tell you there's a book called Skunk Works. Skunk Works is about the Lockheed Skunk Works that developed the U-2 plane and the SR-71 and some other classified airplane projects for the U.S. Air Force. And Ben Rich was the guy who ran it after the founder of that operation moved along. Anyway, it's a fascinating story of using technology and combining it with a very small, thoughtful, incredibly capable team to create, change the world products that persist today as icons of tech innovation.
Yeah, thank you so much for being on the podcast.
Well, it's a pleasure to see you, Grace. Thanks for having me. I hope I was helpful in some way.